So I'm going to record this so we can have a copy of this for folks that couldn't be here today. And welcome to Learn Chapter 2. And again, Chapter 2 has 5 different objectives that are listed here. Our goal today is to get through the first half of the chapter, which basically the first 2 learning objectives. That's because we're going to be introduced to something new and exciting, and so I'm going to take it there. And then once you're used to that, by the time we cut back on Monday, we'll be able to finish the chapter next time we're together. Okay, so learning objective 1 tells you a little bit about cost accounting and something called a job order cost system, which you're going to be learning about. Okay. So the purpose of cost accounting is to make sure, and you know how important costs are. Costs end up being reported as expenses on the income statement. And you know, if you want to make a profit at a business, you want to keep your expenses as low as possible, right? So you can absorb more of the revenue as your profit. So making sure that you know how to measure and record and report your costs, particularly if you're making products, which is a very, complex situation in many cases. You have to make sure you have a way to measure that, record it, make sure you're keeping track of everything. And so that's basically what cost accounting focuses on, okay? What we need to know probably from back in chapter, what chapter was it? Way back in Accounting 104, you might remember we talked about inventory, chapters 5 and 6, way back in the day, right? And you knew that there were 2 types of inventory systems that you learned about. One was a perpetual inventory system, and a perpetual inventory system basically is keeps track of things immediately. All right, everything that happens is recorded as it's happening. And so it's very, very up-to-date information on how things are going. The other inventory system you might recall is called periodic inventory system. And that's because the company stops at a particular period of time, be it a week or a month or what have you, and calculates costs at that point in time. So again, the perpetual inventory systems tend to be the most common ones that are used. And so you're going to hear that a lot. I just wanted to jog your memory a bit. But the periodic system still exists and still is being used. Okay. So perpetual inventory system, again, immediate up-to-date information on the cost of the products. And so how do we keep track of those things? Well, there's 2 different types of systems that are used. The first type is not emphasized in this chapter, it's just introduced. It's called the process order cost system. And so you have a manufacturer of potato chips or ice cream. They just, that's a good system for that. And then there's a job order cost system, which is the focus of this chapter. And so we're going to be learning a lot about that real soon. And that's looking at costs per job. Okay. So process cost systems are very, very common when a manufacturer makes a large volume of the same type of product, like cereal or ice cream, right? Or petroleum, say gasoline. So it's a very, very large volume of basically spitting out the same type of product. So process cost systems are used. They're done on a time period. So like a periodic system, every week they're calculating costs, or every month they're calculating costs in a process cost system. Okay. Again, this is something that is still used today in many different companies that manufacture large products that are the same, like cereal. But it's not the focus of this particular chapter, but it's introduced because it is a system that's used. So your book in this particular case has a wonderful illustration of potato chips production. And I don't know about you, but every time I see this slide, I get a little bit hungry for potato chips. Well, it's actually one of my favorite snacks, sadly. It is what it is. So notice that in the process cost system, right, potato chips are these are all similar products, right? So at the very, very end, you're gonna have a bag of potato chips. Starts as potatoes, you're gonna clean them, you slice them, you fry them to death, and then you put them in a bag to affect people later on. So basically speaking, a potato chip production company would be perfect to use the process cost system because it's a very neat, clean process, and it's all the same product at the end. However, what's more popular is something called a job order cost system. And that's when companies are keeping track of costs for each job. Another way to look at a job is a batch. So we'll talk a little bit about the difference there in a second. And so let's say the job is to make a movie. And so basically speaking, all the costs that you incurred in order to make the movie are assigned to that specific movie. Okay, and so that might be, or a batch. Maybe you're printing up magazines, or that's actually not a good example, but maybe wedding invitations. You have a large, you're inviting 200 people to your wedding, and you have a large batch of these specialty wedding invitations that you have printed. Well, the type of paper, the type of ink, and all the costs that are involved would be assigned to that one batch of wedding invitations, for example. So these are when, again, costs are calculated and assigned to a specific job or what they call a batch. Mm-hmm. So again, the objective of this system is to compute the cost per job or per batch. And that's what we're going to be focused on. How exciting! So here's illustration 2.2, which is on page 49 in your book. So if you have your book and you go to page 49, this is in the 7th edition. I don't think it's going to be changed. It'll be within a page or so if you have the 8th edition. But illustration 2.2 shows how the job order cost system would work. Okay, so here are two specific jobs. On the left side, they're making an animated film. On the right side, they're making an action thriller. What they're going to be doing is assigning this movie a particular job number separate from the action thriller, which has its own job number. And all of the costs that are involved in making that movie are going to be assigned to that job. And this is basically how a job order cost system works. How important are costs? Well, this is a very nice little story. It's also on page 49 in your book. In terms of, businesses really not really understanding cost accounting. Without really understanding your costs, you don't know if you're selling it for the right price. Because when you sell something, you want to cover all of your costs and make a profit, right? So your revenue is supposed to cover all of your expenses, all of your costs, plus give you a profit. Well, if your costs are not right, then you might not be making a profit. And this is basically what happened to a large company that was in the business of rebuilding diesel locomotives. They thought they were making money until they hired a specialty firm, consulting and accounting firm, that came in and said, look, you are underestimating what it costs to rebuild these locomotives. And you're actually losing money on every locomotive you sell. And so, basically what the consultant was saying here is the more contracts it won, the more money it lost. That's not a good way to run a business. But the culprit really is not having a good cost accounting system, not understanding what your costs are. So you are making sure you're accounting for all of your expenses. That's a good little story for now. All right, so there's a flow that you need to know. This is a big part of this objective is not just going with the flow, but knowing with the flow. I don't know, does that make any sense? I try. But we're gonna be going and knowing the cost flow here. Pay attention, drugs are bad. So remember, the flow of costs here represent literally the physical flow of the materials that are used before they're converted into final goods. Now, you can never forget what we just learned in the previous chapter, right? So you have raw materials, you have direct labor, you have manufacturing overhead. They go through a process, right? And what comes out is finished goods. Once the manufacturer has finished goods, they can sell them to retailers or whatnot, wherever they sell their goods. So this is the flow that you need to know. All the manufacturing costs, which are raw materials, labor, and overhead, are first assigned to the work in process inventory account because they're being worked on, they're being created. And so raw materials are being used, labor is being used, and overhead is being used in the process of creating whatever you're creating. Once everything is done, once the job is done, then all of the costs of completing all that work get transferred to finished goods, the finished goods account. And so there's a cost flow, as you see, from the very basic, as raw materials, labor, overhead, to work in progress. As those get done, those costs move to finished goods. Once finished goods are sold to customers of the company, then that cost gets moved to cost of goods sold. So this is the cost flow that you need to know, okay? And this is going to be the flow that we're going to be focused on in this part of the chapter. So here's a wonderful illustration. And this book is big on illustrations, and I kind of really like it, frankly. This is on page 50. Illustration 2-3 is on page 50 in your book. Notice this is the flow. Remember, I was saying you have to go with the flow, you have to know the flow, be the flow. Okay, be one with the flow. Remember, we started off understanding in chapter 1 that there are manufacturing costs. There are raw materials that we need. There is factory labor that is necessary. And there's manufacturing overhead that's necessary. This is how things start. This is the starting point. Once we start working on transferring those raw materials into finished goods, then we're going to be assigning costs from each of these categories to work in process inventory. Again, work in process means they're in the process of creating a finished good. Okay. Once the work in process is done, then those costs are assigned to the finished goods inventory, because now finished goods are goods that the manufacturer can sell to other businesses. And of course, once those are actually sold to other businesses, they're part of their cost of goods sold. They become expensed. Okay. Now that's important because we're looking at basically, these are all part of the subsidiary ledger for inventory. manufacturing costs like raw materials, factory labor, and overhead, work in process inventory, and finished goods inventory are sort of all under the asset accounts in the subsidiary ledger. Once the inventory is finished and then sold, well, then it moves to cost of goods sold, which, as you know, on the income statement because it is an expense account. Okay, so it moves from inventory, which is on the left side here, balance sheet accounts, to once that finished good is sold, it goes over to the income statement, cost of goods sold. So this is the basic overview of the costs, of the flow of the costs here. And of course, this is interesting because this particular example is a fire truck, and I know, I'm not sure if Blaine's driving one right now, but this is for you. This is for you. This example is for you. Okay.
Thank you, sir.
You're very welcome. And thank you for your service. Okay. So let's take a look at how the accounting works. Much of what we're going to be doing in the class in terms of the accounting, this particular section, is going to be on page 50 and 51. Things that you have to know, things that you have to have a reference for. Okay. And so this is important. So there are two basically major steps in the flow of the costs in manufacturing. The first thing is we start accumulating all those costs, which is what we do with raw materials and factory labor, et cetera. And then we assign them. Once we start working on something, we can assign what raw materials are used there, what labor is used there, what overhead is used there. So this is the accounting for that you're learning right now. All right, so first things first, we start with raw materials because we're a manufacturer. So we start with the raw materials. And here's an illustration. Here's an example that you need to know because this will be played out in your exercises for homework. Okay. So Wallace Company purchases 2,000 lithium batteries, and this is their inventory stock number. Okay. At $5 per unit. So they have 2,000 batteries that they bought for $5 each. So that's $10,000 of batteries, lithium batteries they have. They also purchased 800 electronic modules, and this is their inventory number, for $40 a module. So 800 modules at $40 a module, you got $32,000 of electronic modules. So if you have $10,000 of batteries and $32,000 of modules, you just spent $42,000 on raw materials. Okay, everyone okay with that? All right. So this is happening on January the 4th. So this is what the entry is going to be in the journal. Oh my God, it's a journal. Yes, the journal is everywhere in accounting, even in managerial. Yes, even in managerial. You never, ever, ever forget what you learned in financial accounting. That's the rule. Okay. So we are going to debit the raw materials inventory account for the $42,000 of raw materials we just bought. And here we purchased this entry on account, apparently. It doesn't necessarily say that we purchased it on account, but apparently we did because we had to set up an accounts payable. So that's actually one little error I found in this book. Woohoo! But when you purchase something on account, of course, that's an accounts payable. So if you notice, the journal entry on the 4th of January is a debit to the subsidiary asset account called raw materials inventory and a credit to accounts payable. So you have more assets, more inventory, and you have more accounts payable. Remember how that works, right, for your journal entries. So this is something you have to know, in other words. You have to know how to do this because you'll see it over and over again in this class. The next thing is to make sure we're accounting for all of the factory labor. Factory labor really is about three specific costs. Your gross earnings of the factory workers that are making the products. The payroll taxes we have to pay as an employer on those earnings. And any fringe benefits that we have also need to pay the factory workers based on that work. Okay, so those are three important costs to look at. Gross earnings, then the payroll tax that we have to match. Remember, you see that your Social Security and your Medicare tax are taken out of your check. What you don't see is the employer matching it. That's their payroll tax. Okay. And then, of course, fringe benefits like sick days or whatnot. Okay, so here is the next illustration that you need to know. Same company, Wallace. This is on page 51. Wallace incurs $32,000 of factory labor costs. Okay. Of that amount, $27,000 is for wages payable. $5,000 is for payroll taxes payable in February. So what's the journal entry? Oh my God, I said the word journal again. You might journal that, but you'll see. Again, we're going to be working with journals in this class too. It doesn't go away because you're not in financial. So this is what it looks like. The entry at the end of January for Wallace Company is a debit to factory labor. Again, factory labor is on the subsidiary ledger with your inventory. In a manufacturer, we look at things a little bit differently as a manufacturer. So this acts like an asset account, more factory labor. But we also have two liability accounts. Factory wages payable on the credit side means more liabilities. And so these two are on the credit side showing more liabilities. Factory labor is on the debit side showing more of this particular asset. Okay. And then, of course, you learned about this manufacturing overhead costs in chapter 1. You can never forget it. Okay, just never ever forget it. Of course, you know about the overhead costs that are directly related to manufacturing, such as the property taxes on the building, the factory's depreciation, any insurance and repairs, anything related to the manufacturing process, right? Costs that are not related to manufacturing are not debited in manufacturing overhead. They're actually expensed right away. Okay. And so we use a manufacturing overhead account like we use the factory labor account. It's sort of a control account to see how we're doing in creating or manufacturing our inventory. So costs that are related to manufacturing are put into the manufacturing overhead account. Again, it acts similar to an asset account for this process. So here's the illustration back to Wallace in our wonderful world of Wallace Manufacturing Company. At the end, and this is just assumed data, they didn't show it to you in the book, it's just thrown at you for the sake of this. So here at the end of January, the end of this period of time, they have debited manufacturing overhead. Again, this is one of the accounts that is subsidiary of the inventory in a manufacturing business. Raw materials, factory labor, and manufacturing overhead are sort of subsidiary accounts to inventory. And then all of your, so that's a debit of $13,800. And then here you have a couple of liabilities that are set up. Liabilities increase on the credit side, as you know, right? You have accumulated depreciation. If you remember, accumulated depreciation you have depreciation expense, which is going to be part of your manufacturing overhead, and the associated credit goes to accumulated depreciation. And then when you use insurance, you have an insurance expense, but in this case, because we're a manufacturer, it's going to be part of the overhead. And we would credit the asset account, bringing that balance down. So this is all from, hopefully this jogs your memory a little bit on financial accounting, for better or for worse, what have you, but that's the reason for these particular entries here. So, knowing all of what you know, this is practice on learning objective 1, okay? So the 3 things we just went over, raw material costs, factory labor costs, manufacturing overhead costs, and the entries you just saw, we're practicing. We're practicing. That's all we're doing, practicing those entries. So let's take a look at our do it exercise, and let's do it. Oh yeah, ooh, I am on a roll today. It's a good day. All right, so here we have, during the current month, KTR Company incurs the following manufacturing costs, okay? The first cost here is they have raw materials that they purchased on account. Okay, so on account, we know it's on account. Second is we have factory labor. Third is, looks like we have some manufacturing overhead, okay? So let's do one at a time. Prepare the journal entries. Did I say journal entries? Yes, I did. More journal entries are on the way. You never get away from the journal. Okay, accountants should be very thoughtful people because they're always journaling. Sorry, another bad joke. So the journal entries that we have to prepare, we're going to do one at a time. So the first thing, raw material purchases of $4,200 on account. Now, we just saw that just a couple of slides ago, right? We just saw this exact same thing happen a couple of slides ago. And you remember what happened? Well, you might remember that we debited the raw materials inventory account and we credited accounts payable. And if you remembered that, you would have got this correct. If you don't remember it, the good news is the do it exercise is done for you. The solution is provided for you on page 52, at the very top of the page. Or if you're reading the online book, right after the do it exercise is explained. The second part, B, we have factory labor of $18,000. $15,000 is specific to wages payable. $3,000 is specific to payroll taxes payable. So what's the journal entry going to be? Well, you're going to debit your factory labor by $18,000, and you're going to credit your factory wages payable, $15,000, and your employer payroll tax payable, $3,000. Just like we saw 2 slides ago or 3 slides ago. Would you agree? You remember? Okay, good. Hope you remember. Drugs are bad. Just remember. All right, the last one we look at here is manufacturing costs. And here we have a bunch of things that we have to look at. We have factory utilities of $2,200. Prepaid factory insurance of $1,800 has expired, and we have depreciation on the building, okay, so of $3,500. So you simply add those up, and that's going to be the debit you're going to be making to manufacturing overhead, $7,500 debit to manufacturing overhead. And then the credits are going to be assigned to each individual account based on what we just did. So we had a utilities payable of $2,200. We credit prepaid insurance because we use that up, and we credit accumulated depreciation. Okay. So this is learning objective 1 in a nutshell. I'm going to stop the recording.